So thank you for coming. I think that one of the beauties of the IFA seminars is that we have the chance to discover something which is very important to all of us. We are tax practitioners. We live in a tough world. We have plenty of nightmares. Nightmares include the aggressive stance of the tax authorities, the complexity and uncertainty of all the regulations you can think of or that you can imagine, the lack of understanding, to say the least, by the public opinion. So when I come here, I find colleagues and friends, because we are truly friends, from this global community of tax advisors. We recognize each other as members of this particular community. But in any case, we can also realize that we have a fantastic life because we are devoted to a profession with very interesting challenges. So today, I'm here to present, to introduce into the IFA world the Taxand Alliance. The Taxand Alliance is a network of 50 different firms in 50 different countries around the world. All of us, we are independent firms with a strong tax practice, of course, devoted to quality, who is not devoted to quality, with a strong compromise to work together for the better service of our clients, and with the clear intention to strive and to be able to promote the activity in our difficult world. And what better to start than to discuss something which is a continuation to what we're listening this morning from the OECD, which is all the changes that are arising from the discussions about the not finalized BEPS 1 action about the taxation of the digital economy, which we are seeing today is going to have much broader implications, maybe outside the scope and the realm of the digital world. So let me introduce your panelists. We have here Jens Brodbeck from INS South Africa, who is going to speak from an African perspective. We have Xavier Dietz, who is the alma mater of this presentation from Flick Sandberg. We have Kim Kyu-dong from Yulchon, Korea. We have Suhail Natali from Economic Laws Practice in India. And we have Ernesto Perez from Alvarez Marsal. I'm Ricardo Gomez from Garrigues. I have the pleasure to be somehow directing the traffic, not more than that. The people who really know about this are sitting there. And so I pass the word to Xavier.
Yeah, thank you very much, Ricardo. Ladies and gentlemen, welcome to our event today. We would like to discuss with you the current developments at the OECD and the inclusive framework on BEPS regarding the redefinition of taxing rights in market countries. I think many of you already attended the session this morning in which a very similar topic was discussed, but on a very theoretical, technical level. And the purpose of our panel discussion today is to do that a bit more on a practical basis, to discuss together with you and to show you what that would mean from a practical perspective. And therefore, we have prepared some case studies which we would like to discuss here at the panel, but of course, if you would like, also with you. Quick overview on to the agenda. I will start with an overview of the developments in the last month and years. Then we will discuss details of the proposals of the inclusive framework on BEPS regarding the redefinition of taxing rights and the new profit allocation rules proposed by the inclusive framework. And then finally, we will come to the minimum taxation, which is pillar 2 of the proposals described in the working program of the inclusive framework. So I will start now with a very quick overview what happened in the last 2-3 years in this context. As all of you know, and what was already mentioned by you, Ricardo, the outcome of the BEPS Action 1 report of the OECD was not really satisfactory. because there were no clear recommendations included how to tax the digital economy. And that's why the OECD and the inclusive framework on BEPS continued to work on this topic. And as you can see on this slide here, in March 2018, so 1.5 years ago, the inclusive framework published a first interim report dealing with the tax challenges arising from digitalization. And from my perspective, in this interim report, it was the first time where the idea was born to define a new taxing right without a physical presence in the local market, in the source country. And then the inclusive framework further intensified its work. And probably you know that a first huge step was then made in the beginning of this year when the inclusive framework approved a policy note with 2 pillars. Pillar 1 focuses on the allocation of taxing rights and the review of profit allocation and nexus rules, Pillar 1, and Pillar 2 refers to the right to tax where other jurisdictions do not exercise taxing rights or tax too low. So it seems to be a far-reaching development because the policy note explicitly points out that a new concept of taxation refers not only to the digital economy, I think that's important to mention here, but also to the traditional economy. So I think we have to accept that we are talking now about taxing rights, not only in the area of the digital economy, but I think the development goes clear in the direction of an application of these new rules to all sectors of industry. Then in March of this year, there was a public consultation meeting in Paris at the OECD. And it was obvious that the countries of the inclusive framework on BEPS, that they see the risk that each country will adopt uncoordinated unilateral tax measures, as we have seen them in France, for example, or I think Austria discussed such a digital tax as well. And to avoid such unilateral tax measures, it was clear, and I think there is now a political consensus that the inclusive framework on BEPS would like to develop a new right to tax on a global basis for all sectors of industries. And this is then presented in a bit more detail in a program of work which was published in the end of May of this year, in which Pillar 1 and Pillar 2 is described a bit more in detail. But please, we have to take into account this is only a working program. They are far away from any results. A lot of questions are described in this program of work. However, and that's very interesting for me and for us all, from a political point of view, there seems to be a consensus to redefine international taxing rights in favor of the market companies. This was explicitly confirmed at the meeting of the G20 finance ministers in Japan in the beginning of June of this year. And Ernie, probably a question to you from a US perspective. I think your President Donald Trump did also some coordination with the French President Macron at the Briary meeting to come a step forward. Is that correct?
That is correct. And I just want to add that Ricardo was mentioning about the nightmares that we all have. And we have a nightmare, which is a tweet every morning that we in the United States. But Zavra, going to your point, I think that the threat from the U.S. was increased tariffs or trade measures because of the digital tax in France, and they were able to reach an accord which doesn't prevent the application of the digital tax on U.S. companies, but ultimately would give U.S. companies a credit once the BEPS initiatives are implemented. But I think overarching point is that the U.S. is very much of the mindset that something has to be done. I think if you were all at the breakout earlier this morning, I think that one point the U.S. has mentioned is that anything that is done should be a broad-based approach. It should not be very limited. That, in the opinion of the U.S., will not provide for a long-term solution, and we'll end up with BEPS 3.0 in a matter of time. But the U.S. is very much on board that something needs to be done that is broad-based and builds on the arm's length standard.
Okay, well, thank you. Jens, how's the situation in South Africa? So I think from an economic perspective, totally different to the US. Can you comment on that?
I think from a South African perspective, there's almost kind of mixed messages being sent at the moment. So if you look at South Africa in isolation as a country, they, for example, they opted out of the extension of the PE article in terms of the MLI. So there was clearly a reluctancy to extend the definition. And also they haven't implemented any unilateral measures apart from a requirement for digital service providers to register as VAT vendors. But on the direct tax side, they've been very quiet on those issues. But if you look at it in a bit of a wider context, they're very active through the African Tax Authorities Forum. There's a lot of contributions happening from that side. So instead of going for a one country approach, it's more about a regional approach towards that. And the ATAF has issued a number of technical interpretation notes on that, where they made it very, very clear, where they stand on some of those technical issues, and they're certainly very strongly supporting, the underlying theme of allocating more profits to the target jurisdictions. And they're trying to be part of the discussion as a group of companies through ATAF. And I think I read one quote which was quite interesting on that one. They said, look, if you're not at a table, you're on the menu. And I think that's the concern that a lot of African and developing countries have at this stage.
Kim, what about Korea? I think it's very similar to the US perspective, or not?
Interestingly, last year there was a lot of discussion and huge disputes between politicians and media report about how to tax digital economy. And there are some hostile media report toward US giant multinational ICT companies. And as is the case of European Union, the media report says US companies are not paying fair amount of tax in Korea. But interestingly, Ministry of Finance and Economy released the press report and say, any measure, any digital economy taxation measure may have adverse impact on Korean ICT company. Korea is actually ICT exporting country, not importing country. So after that, there was no real debates, and now the Ministry of Finance and Economy, their position is to actively participate in the OECD discussion and support the long-term solution for how to tax digital economy, and not introducing any interim and unilateral measure targeting digital economy for the time being.
Suhail, finally, India. From a German perspective, I observe that you are always very creative to define taxing rights. So something new regarding digital economy?
Well, thank you for being so polite about it, but
sorry for that.
That's okay. You said. But the situation here is that India continues to work with OECD to find a solution. Having said that, India is perhaps the country which has the largest number of users on most of these internet websites because of the Chinese situation. A lot of them are not allowed to operate in India. So a lot of value is being created through India, and India has already, in a manner of speaking, gone ahead. We have, of course, the GST registration on the indirect tax front that's done. Two, you need to, there is now an equalization levy where if you earn more than $1,500 equivalent out of India, you have to, the Indian buyer has to pay a 6% tax. And that tax is retained in India. Right now, it's not a credit under the DTAA, and what happens is that the companies are building it into their price. But it's been there for 2 years, and it's growing about 60% year on year. We also have, we're sort of all dressed up on the significant economic presence position. We have the legislation in place. We brought it in the last budget, and we just need to notify the thresholds. So as soon as OECD comes out with some sort of a guideline, or even if it doesn't, sooner or later, India is going to take a step in this direction.
Thank you, Suhail. So we would like to continue now with a bit more detailed analysis and discussion of the new concept proposed by the inclusive framework on BEPS. So, ladies and gentlemen, we will now have a deeper look at the plan to expand taxing rights of market countries. And the plan is of the inclusive framework to develop a new concept in this context when there is no physical presence in the source country. However, what does that mean? And it's, of course, also a technical, a legal question. Currently, we have the definition of the permanent establishment pursuant to Article 5 of the OECD Model Convention. The arm's length principle is implemented in Article 7. And can we continue with such an approach? So my feeling is that this will not be possible. Probably I start again with you, Ernie. What's your position? Do you think that such a new taxing right can be implemented in the current system of the double tax treaty law, or do we need something new?
I think there's a lot of design features, Alvar, that need to be considered. I think that the devil's in the details. But treaties, you have situations where you have countries that will be losers in the sense that they'll have to grant an exemption or part of what they will lose in terms of their tax revenue. So I think that from a practical approach, anything that's done would need to consider a lot of different factors. However, saying that, at least from the perspective of the United States, we feel pretty strongly that anything should be based on the arm's length principle. So that as a starting point. And when you think about it from that perspective, that really eliminates a couple of sort of proposals that I think we have felt have been too narrow. So when you think about the user proposal, I think the comments from the U.S. has been those are too narrow, because I think those don't take into consideration workforce, marketing campaigns, strategic direction, and other type of marketing intangibles that would be considered in generating value. Now, when you speak of marketing intangibles and you start comparing that to user proposal and also the significant economic presence, now you're looking at the broader multinational. So now you're going beyond just what our friend from Korea was talking about, which was, just subject to the digital economy and not everything else. So I think that it could be implemented, but it would really require building upon arm's length and taking into consideration multinationals, not an entity-by-entity perspective, not a service line perspective, and also taking into account treaties, losses. What do you do with losses? What happens when you have a loss one year and the following year you have income? How do you allocate those losses? So there's a lot of design features that would have to be factored in to give countries certainty and taxpayers certainty that whatever we come out with, whatever ultimately is come out with, can be done in a pragmatic manner.
Mm-hmm. Yes, I think the arm's length principle is a good topic. So for me, it's very interesting that in the context of the BEPS project of the OECD, they again and again pointed out that the taxing right should follow the functions performed, the risks assumed, the beneficial ownership of intangibles. However, the new approach is very different. They do not look anymore at functions performed or risks assumed. Instead, it's a customer base, it's a buying power, or a customer demand, which then has the consequence of a taxing right. So that's a totally new approach from my point of view. And Ricardo, I think you wanted to guide us now through the next questions, which are presented on page 13 of our presentation.
Correct. But before we move into that, I would like to point out that, again, when you are replying to the question of which is the position of a given country, I think that there are countries which have already expressed their position, but in the inclusive framework we have 129 countries, and many of them will be for sure in the Spanish position. 4 governments in 4 years, and nobody is able to understand which are the consequences of these policies. So maybe we are communicating to our clients the opinions given by a number of tax officers in the ministry, which later on may be completely discarded by the government, which is in place when the decision has to be taken. So the replies from the tax officers are rational. They look into the revenue computation for each of the countries, but at the end of the day, there is always a point of political uncertainty or political interest that can perfectly redefine the position of a country at a given moment. So, but having said this, I think that it is important when we discuss all this to try to understand what we're speaking about. And there is a question which is, well, when we have to define a taxing right of this nature, how can we define it and how can we sustain it from a logical perspective? And is there a way to avoid the spillover of this concept outside the digital world, taking into account the interest of the different countries and especially the way that conventional industries are moving into the digital realm? And I think that maybe, Suhail, you can start replying to this question.
Thank you, Ricardo. First, just to talk about the reallocation of the taxing rights, India has been very vocal about this and not without reason. For one, we're not net exporters. 2, we have the largest database, the user base located in the country. And if you see the consultation papers and the steps that keep coming out from the government of India from time to time, it focuses this issue. To go back to what Ernesto said on the arm's length principle, yes, that will have a role, but it will have a limited role in the whole new tax structure. Of course, the challenge will be the apportionment of profit, and the government of India has also taken a OECD-supported view on active users and passive users on the digital space. To specifically answer your question, Ricardo, it is going to be a huge challenge because it's when we discuss this, we're struggling to think of an industry that will only remain in the bricks and mortar place. There will always be an overlap between the digital and the bricks and mortar space. And with that, yes, it's going to be very difficult to control this only into the digital space, but of course we'll have to keep trying and coming out with innovative solutions because, as all of us know, laws can never keep up with technology, so we may have the BEPS 3.0 sooner rather than later as well.
Ricardo, if I can add, because I think we keep talking about digital, but intellectually, I think data, whether you download it from a social media platform or whether it's a pharmaceutical company that has data on customers, the way you acquire that data, the way you store that data, and the way you apply that data, that's the value. That's the value. So when I look at these proposals, it's hard to ring fence just pure digital businesses because data is such a big factor in all businesses today, and I think they're growing. There's not one entity, whether it's the automobile business, whether it's in the pharmaceutical industry, where data doesn't play an important role. So I think from a practical perspective, so I agree with you. The question is, how do you capture the value drivers to really be able to allocate that non-routine profit to those market jurisdictions in a fair way at the end of the day? But that means that another jurisdiction where those residual profits were residing in is going to lose. So, and depending on whether you're an export country or an import country, you stand to win or gain. And those are the dynamics that we're playing with.
I think from an African perspective, Africa obviously hopes in the future to be one of the winners from that development. I think that's kind of a unique chance that Africa, I think, sees for
Jens,
itself.
sorry for jumping in. That's what the German fear, that you win and we will lose.
I never thought the Germans would be scared of the Africans, but it seems to happen. So I think, therefore, ATAF is very supportive of that process, obviously, because they're hoping by allocating more profits and taxing rights to market jurisdictions, they will, for the first time, maybe get a kind of fair share of the pie. And therefore, they're supporting, in a sense, all 3 proposals. and hope for some divergence of the three. But the main focus is really on the marketing intangible side there. And I think, different from my earlier speakers, instead of trying to limit the application of those proposals to certain industries, Africa goes the other way around. ATF makes it very clear that I think those proposals should be applied to almost all industries. The only exception being commodity-based industries, because obviously that, again, in terms of commodities, we're sitting on the other side of the fence. So it's very clear that ATF is of the opinion that if it comes to commodities, there is no such thing as marketing intangibles, which is very interesting to see that, yeah.
In Korea, actually, Korea has, when it comes to new nexus rule, permanent establishment rule, we've been quite active adopting all the OECD recommendation, like Action 7 recommendation. We fully adopted into domestic PE regulation, and we are one of the initial signatory of MLI. We originally opt out PE article of MLI, but Korean government is currently seriously consider opting in near future. But when it comes to digital economy and new nexus, concept of new nexus, they are taking a conservative and rather cautious position. Of course, we will adopt it and review it, but we really take a cautious position. The thing is, we are concerned about the user participation, as correctly pointed out by Oni, is so narrow. So, but user participation, one thing good for Korea is user participation clearly limit its application to digital economy. Our main concern is any new proposal like intangible marketing intangibles and significant economic presence may possibly have an impact on non-digital economy. And Korea is top 10, 11 economy in the world, but when it comes to export, we are number 5. So Korean economy is heavily driven by export. So any proposal which may have an impact on Korean multinationals, they generate profits 95% outside Korea. And then, if the OECD come up with any solution which may have an adverse impact on Korean exporter, that will have a significant impact on the Korean economy. So we support OECD and we actively participate, and we basically follow the US model, marketing intangible, but we really wanted to make sure that the marketing intangible proposal is only applies to so-called digital economy, non-conventional economy.
So then we move to the next section, which is the new profit allocation rules. Javier?
Yes, thank you, Ricardo. I suggest that we directly jump to page 16, which is an overview of the 3 proposals of the inclusive framework on BEPS. So regarding the new profit allocation rules, there are 3 proposals described in the working program of the inclusive framework. The first proposal is the user participation proposal, which defines a taxing right if user of a market a country uses digital service. So obviously this proposal directly refers to the digital economy. And then Ernie, the second proposal, I think it was developed by the US government or IRS, which refers to marketing intangibles. So it's a marketing IP nexus. Probably you can say a few words.
Yes, it's safe to say that U.S. as a proponent of the market, or is the one that basically put forth the marketing intangible proposal, which is based again on marketing, IP, intellectual property, workforce, anything that we traditionally have earmarked as intangibles that help you exploit markets and different segments. And that's certainly the proposal that the U.S. Is an advocate of. And again, that proposal starts with the arm's length principle, which is a sort of a common theme that the U.S. has indicated over and over again. When you take a step back, Xavier, I think that ultimately where I see this going is probably a combination of all these proposals, because when you think about when you allocate the non-routine profits, and you're then defining how do you allocate those non-routine profits to those market jurisdictions. It seems to me to be common sense that you would take into consideration user use, use by the certain country members and other in-country criteria in order to basically say, okay, that should be allocated to the marketing jurisdiction. So ultimately, the U.S. started with marketing intangibles, but I think as this develops, it's probably going to be a combination of these proposals.
Okay, and it seems to be in line with the arm's length principle. I think that's
Yes.
It's a must for the U.S. side
It builds on that.
to continue with the arm's length principle as the main standard for the profit allocation.
Correct.
Yeah.
Correct.
Yes, then the third proposal, Suhail, I think it comes from from India. Significant economic presence as a nexus to tax. What does that mean?
So, before I answer that question, just to put it in perspective, we heard Kim from Korea say that there was a situation where they're the 11th largest economy and the 4th largest exporter in the world. India is just the opposite. We're the 4th or 5th largest economy, depending on what data you look at on which day. But we are certainly not in the top 10 in exports. But the value that the consumer brings and the government believes that they're not able to capture the full potential of it has brought into us in a position where we're different from the US. And we want that the users and the sales in India play a huge element in the taxation structure going forward. Now we can look at it in terms of how it will affect the old economy versus new, whether it is incremental profit, whether it brings synergistic values. But the fact of the matter is today we have a law on the books which is just waiting for notification of thresholds. And as you figure out from the equalization levy, India's thresholds are not very high. $1,500 is really meaningless for digital advertising sales. When we come across, when we find support at the OECD, I don't think we're still ready to jump the gun. We will bring these laws in, and then as Ernie said, this is going to be some give and some take, and India has already put out a consultation paper which accepts 10% where the user is passive and 20% where the user is active.
Yes, we already started to discuss profit allocation rules. What's the future of the arm's length principle? If you look in the working program of the inclusive framework on BEPS, obviously they tend more to apply profit split methods, so that's new. And here we are talking about a modified residual profit split method. Then secondly, a fractional apportionment method, which then allocates some kind of portion of the residual profit to the market company. And then finally, a distribution-based approach. So we decided not to discuss these technical details with you today. Instead, we would like to discuss a case study with you. And the question was, what does this new definition of taxing right can mean for a multinational? And Ricardo, the floor is yours. You wanted, I think, to present this case study a bit more in detail.
Well, let me try to present the case study because, again, every time you go into the complexities of a group, you can identify more and more issues to be discussed under the new rules. But this is a perfect example of an entity which is in the old economy because it sells furniture, but it has a structure whereby the parent company is located in a developed country, the US, France, Germany, Korea, and all the functions are taking place outside this country. You have manufacturing entities which are working as of today under contract manufacturing structure, cost plus 5% in different countries. You have an R&D location in India, which is also working cost plus, billing the services to the parent company. And then you have distribution companies which are selling the products to the clients, which are using their website, which are at the same time they are working with a furniture app, and they are of course working with a customization program. The e-furniture company is acquiring the goods from the manufacturing companies and it's supplying them to the distribution companies with a transactional net margin method with a return on sales of around 3%. And this is a pretty standard model where you have almost everything that is going to be subject to discussion starting by the proposal that we are examining. And I think that the first question to be discussed is whether or not, well, this is, as I said before, based in the current transfer pricing standards and the state of art of transfer pricing, whether or not the new proposals are going to be or are going to imply something close to the end of the transfer pricing world that we've been living with. And I will start maybe with you, Xavier, so that you can give us some ideas about this.
Yeah. So I understand the proposals of the inclusive framework on BEPS in such a way that in the future the country of residence of the distribution company will get a new taxing right to tax residual profits of e-furniture company in the market country. So that would mean that in addition to the 3% return on sales, which is allocated by applying TNMM to the distribution company, there will be an additional right to tax a part of the residual profit of e-furniture company. And therefore, from my point of view, that would mean that we apply the arm's length principle in parallel to the new nexus of the definition of a taxing right, which would then mean that e-furniture company itself has to file a tax return for, I would say, a limited tax liability in the country of the distribution, in the country of the distribution company. So, from my point of view, we still apply TP rules. However, it's the question, is that consistent? In addition to that, we allocate some part of the profit generated by e-furniture company to the market country, and obviously the tax administration responsible for e-furniture company will be against such new rules because they obviously will lose tax base. So therefore, from my point of view, that's my understanding. I think the working program is still not detailed enough to understand that, but I would say arm's length principle, TNMM, will continue to exist. However, then combined with an additional taxing right of the market country.
Okay, what is the view in Africa, Jens, about this?
I would be very surprised in Africa if it would work out that way. I mean, if you read if you read the ATF views on that, it sounds they're not very clear, to be honest. But I think at the moment, nothing is really very clear. So, but at the moment, it sounds more like, I mean, where African countries are very kind of, where there's a consensus certainly is that there's a view that the arm's length principle in its current form and the transfer pricing rules in the current form are too complex. And that therefore there's a requirement for some form of simplification. I think that's the starting point. And then, what ATF is strongly supporting is kind of the distribution-based approach. So that there would be some minimum margin or minimum profit allocated to marketing, distribution, and interaction with customers or users in a country. It's important to understand that they see that as really as a minimum guaranteed margin. So they don't look at it as a safe harbor where there's an opt-out if you can show that from an arm's length perspective, the margin should actually be less than that baseline amount. But on the other side, they say there should be the possibility for an uplift if, from an arm's length perspective, you can show there should be more money staying in the country. And in my mind, if I look at the new rules, you look at the marketing intangible, the result of that, what most likely would happen in that context is that the African jurisdictions, the tax authorities would argue there should be an uplift on the margin based on the marketing intangibles created in that local market through kind of a sustained activity interaction with customers in that country that creates some brand perception in that jurisdiction. So I think that's kind of how I see it at the moment, but it's not very clear at this stage.
Henrik, would you like to comment on that? Because I think that the US perspective is to defend the transfer pricing model till the last drop of blood.
Yeah, no, I would agree with you, but I sort of view it very similar to Xavier, how he viewed it, because I think when you look at where arm's length principles end and the new paradigm begins, you would add a level of how do you allocate that residual profit, which has been sitting in e-furniture company to that distribution country, that market jurisdiction. And that's really the unknown, because, for example, they're in developing those marketing intangibles that might benefit that market jurisdiction, there are costs that have been incurred. There are people that have been working on it. And you could be talking about a jurisdiction that is fairly nascent in terms of the distribution chain, or one that is mature. So how exactly do you basically account for those items in allocating? But I think that Xavier was saying, I would expect that even from a U.S. perspective, there would be a top-off at that distribution country level. How much, that's obviously the details that have to be concerned. And for example, I'll throw this out there. Do you really, is the company required to file a return? Or for example, is this looked at a multinational, like one global entity in doing this? So really it's just an adjustment to the distribution company. And the other thing, for example, what happens if it took years and years? That investment was done prior to the transformation or going into this new methodology. Do you take that into account? So there's a lot of design questions that need to be factored into this, but I think if you take the proposal at its core, you would see some residual profit being allocated to the distribution country, the market jurisdiction.
Suhail, we have put the R&D company in India, and it was for a purpose, because you are a country with R&D and technological support activities by the millions of employees. How is the current status, and how is it going to evolve?
So as things stand today, R&D is almost a settled position. You do it on a cost-plus basis. So the controversy around that is much lesser than the other tax controversies that we have. Having said that, just from a complexity position, of course, there is a lot of complexity on how you're going to be assigning profits and what you're going to take into account. But India seems to be taking the position in terms of quantifying it in terms of the number of customers or your sales within the jurisdiction. And the language that they've used in the legislation already in place is what they talk about continuous solicitation within the Indian market. And if they see that, they want to be able to tax the multinationals. So there's going to be a lot of discussion around this, but I suspect that the solution will have to be much more simpler for it to fly within all the jurisdictions.
Okay, thank you, Suhail. And by the way, you will be surprised that during all these discussions, we haven't touched base with the digital services tax proposals and realities. We reached this consensus maybe because all of us consider that this is an indirect tax, and so that goes along with the people in the indirect tax world, or maybe because we think this isn't going to fly. Before I ask the panel, let me give you my personal view. And my view is that this kind of transitory taxes are one of the most dangerous creations in the tax world. Once a tax is introduced, It will be there for a long while. It is very difficult to kill a tax which is raising taxes. So that's, but having said this, that's my view. We had in Spain an extraordinary tax that lasted for 40 years. It was supposed to disappear. It was converted into a standard tax. Xavier was telling me that this extraordinary levy for the reunification of East Germany and West Germany is still in place a good number of years after that took place. So my view is that we're going to see more digital services taxes in the coming years. But I will ask the panel which is their view, and then I will make a survey among you. So which is your view? I mean, you can express your views. Maybe Jens, this is outside the Africa's reality, or?
I think it is outside of the reality.
And what about Korea?
It's very clear that I think the approach is really to kind of go together as a group and not unilaterally impose this kind of taxes. I think they're quite complex also, so there wouldn't be too many countries, that would be able to implement such a tax.
What about Korea?
Well, yeah, Korea is basically actively participating in OECD discussion, but currently are not consider adopting unilateral measures. And we believe unilateral measures is only temporary, and unilateral measure like digital service tax is contradicting the fundamental principle of income taxation. So there are some political pressure and media report, but Korean government current view is we are not adopting the unilateral measure for the time being, and just actively participate OECD discussion and adopt long-term solution once OECD finalize their review.
Yes, from a German perspective, I think Germany fears to lose tax revenues. However, we would like to sell our excellent products on a global basis in the future too, and therefore I see a political development that the German government will follow this proposal of the inclusive framework on BEPS.
So from India's perspective, notwithstanding the fact that we seem to be moving quickly and perhaps ahead of the OECD, that's not really the case. Even in the equalization levy, there was a BEPS action plan justification for India to levy the tax, and even the significant economic presence, India is going to work with the OECD to come around with a solution.
Yeah, from a U.S. perspective, I think the U.S. has been pretty clear. They want a consensus approach and not a unilateral approach. I think they have even gone as far as saying that any digital tax is a discriminatory tax against U.S.-based companies. And again, if you know our president, he's willing to escalate things. So I hope, for all of our sake, that the 13 jurisdictions, I think the 13 jurisdictions that actually have passed some sort of digital tax, that don't get implemented, and we don't see more than no more countries actually taking action.
So let me ask you one thing, and let's focus in a specific country. Spain will follow France. So let's speak about France, which is the new leader de l'Europe. Which is your view about the French digital tax being implemented and being here for the next 3 years at least? What do you think about that? Do you think it will be implemented? Raise your hand. Yes. Yes? Yeah. Frédéric Donadier, the chairman of Taxand, says yes. He's in good contact with Mr. Macron, so for sure that'll be the case. But what about the rest of the room? Do you think that we will see the French tax implemented as expected? Yeah?
Really? Wow.
Not real enthusiasm for the French tax, but no, it is interesting. However, we decided that we are maybe too orthodox, that the DST proposal was outside of the realm of the futures, medium and long term, and maybe we are completely wrong, but please don't tell our clients that we don't believe in that tax, because it will come to us somehow very quickly. So having moved through this approach, you were discussing, and this is important, the practicalities of these new realities. Do you think that moving into these new realities will create further more complexity in the way taxes are computed and tax returns are presented in the different countries? Xavier, what do you think about that?
Yes, of course. The complexity will increase significantly. I think it's a very typical group structure which we presented here, and obviously we will then be confronted with new declaration obligations in market countries. And I really have some concerns that we will end up in a lot of uncertainties regarding the definition of this new nexus and the application of the profit allocation rules. Therefore, as a tax advisor, I have really concerns if this is a good development.
Well, let me add one more point. I can't disagree with Javier, because thing is, we are talking about allocating more profit to marketing jurisdictions. And speaking of the example of e-furniture company, if we increase the more profits to R&D jurisdiction and market jurisdiction, obviously, no doubt, the parent jurisdiction will report less profits. And no doubt, new profit allocation rule clearly deviates from the conventional and fundamental transfer pricing principle, which determines arm's length price based on FAR analysis. And higher profit is allocated to the market jurisdiction simply because there are customers, and customers are creating value. Of course, there got to be certain value, but I'm really doubtful whether the tax authority in the marketing jurisdiction should have a taxing right over significant portion of M&E profits which are not necessarily contributed by the entities in that jurisdiction, like marketing subsidiary and distribution subsidiary. So this creates a lot of complexity and deviates from fundamental principle of transfer pricing rule. Of course, depending on how we can work further, we can minimize complexity, and depending on how we can develop modified residual profit method, we are not necessarily resulting in the end of the arm's length principle. But I guess there are a lot of things to be done and a lot of work to be done.
I would add there's nothing easy about what we're talking about. I mean, complexity is at its core in everything we're talking about here. But the alternative is for each jurisdiction to then basically go on their own to implement something. So it's something that has to be addressed from my perspective. And the three overlying principles that got us here. The origin of this discussion was that you had a limited presence in companies exploiting markets. You had significant concentration of residual profits in low-tax jurisdictions. And then you had users in market jurisdictions creating value that was not being captured. Those three things need to be addressed. Otherwise, we're going to be back here in BEPS 3.0. And at the end of the day, whatever comes out has to provide certainty for taxpayers, and there has to be dispute resolutions in place to be able to address those things. And all that brings a high level of complexity. So I don't think there's anything easy here, and but the alternative, I think, is worse than not addressing it in a consensus manner.
So my last question in this section: do you think that we are prepared with the current measures to avoid international double taxation and the current instruments? We are prepared to tackle with all this new complexity? Because my personal view is that we say that the measures are in place, that they are improving, but the reality is that we are facing double taxation, or simply we don't know what's going to happen because processes are so long that you retire before the cases are solved in one manner or the other. But having said this, do you think that enough work is being done in this particular area of the methods to eliminate and the procedures to eliminate double taxation? Kim, maybe you can reply to that initially.
I believe there are really practical issues, and based on my a limited review of the latest discussion agenda and action plan and paper issued by the OECD, I guess there are a lot need to be done. And practically speaking, as a practitioner, I'm not 100% sure how can we really implement and achieve current proposal without impairing the fundamental principle of transfer pricing rule.
So if we look back to the BEPS project of the OECD, obviously there was no international consensus to integrate the obligation to avoid international double taxation in the double tax treaties and the OECD Model Convention, like arbitration proceeding. A lot of countries did not accept that. And therefore, also regarding this new project, I'm afraid of a situation not to avoid international double taxation. For example, Jens, what you said, that from an African perspective, you have totally other views on the allocation of profits to your country than industrialized countries, and therefore it should be a must for the OECD to implement the obligation to avoid international double taxation. But however, if there is an international consensus on that, I have some doubt.
Suhail, which is your view on that?
So I wholly agree with Javier that this is going to be excruciatingly painful in transition. Have we done enough of work? I don't believe, not at the pace that it really needs to be addressed. And I believe that in the short term, maybe the multilateral agreements will have to step in and fill up the void. But I don't know how long that is going to take either.
Yes, Ricardo, I think the answer to your question is no. I don't think the current system basically has what we need in order to avoid double taxation. I think on the flip side, practitioners such as ourselves and companies have been voicing those design features that need to be implemented to avoid double taxation. And I think those have registered with the OECD. So I think in order to avoid double taxation, those design features need to be implemented because the current framework that we have today will result in double taxation under these proposals.
I agree. I think there's definitely a squeeze on the entrepreneur in the group. I mean, there will definitely be less margin remaining there. And then the problem is, so for example, ATF is very clearly against mandatory arbitration. And I guess that's to a large degree a question of resources. So any kind of dispute resolution is extremely difficult if you don't have the resources in your tax authorities to deal with that. So, and that is not something you can fix quickly.
So then let me get outside our script for a moment, because I want to sell my product. That I will retire without having had a single person approving it. But I was really in love with the European Union proposal about the common consolidated corporate taxable base. And let me put it in perspective. I think that the complexity may be so large for multinationals that do you see any room that a formulaic approach along the lines of the European Union proposal can be built as a safe harbor for multinationals, so that they are operating in 20 countries, these countries sign off for these proposals, and they commit themselves to prepare their tax returns following the lines of this common consolidated taxable base, as a means to say, well, this is a safe harbor. If you are there, we will speak later about minimum taxation, of course, and minimum tax rates, but if you are there, you are safe. Your silence speaks very loud to me. Nobody follows my...
Let's move on to the next topic.
Okay, I don't want to get rid of the transfer pricing specialist. It isn't my proposal, but I think that thinking along these lines can have some merit, because the complexities will create really difficult situations to many corporates. So, because the last chapter we want to touch base with is the one that deals with minimum taxation. So maybe Ernie, I wouldn't say that this is an invention of the IRS, but or the U.S. Congress, but I think that you are more used than us right now to deal with the complexities with your new GILTIs and BIT and other
all the acronyms.
Instruments.
Yeah. Ricardo, before I start on this, I do want to go back to your last comment, because I'm not intimately familiar with that European proposal, but for those of you who are familiar with the United States, we have 50 states. 47 of those states have taxation rights in their own regard, and we have a formulaic approach to how we allocate tax, which is based on people, payroll, sales and assets. And with some nuances, it has worked for many years. I think that when you export that to a multi-country perspective, I think what that framework doesn't capture are the value-added features that currently drive the digital world in terms of marketing campaigns, intellectual property. So it might be a good framework to build upon if you can add those value-add features, but it's interesting because it resonates with me because that's what we live with in the United States. But now, turning to minimum taxation, earlier I said one of the issues of the origin of the discussion we're having is because you have a large concentration of residual profits in low-tax jurisdictions. And BEPS 1.0, as I'll call it, didn't address that. So what the second pillar of the work program is trying to address is how do you basically take into account these profits that are being parked in low-tax jurisdictions. And the pillar really implements two rules that are interrelated. The first one is we call them an income inclusion rule, which is in essence, it's a minimum taxation. A lot of this rule draws a lot from what Ricardo said. If you go back to the United States, we implemented tax reform at the end of 2017, effective 2018, and we adopted a minimum taxation for the first time, really in the form of our GILTI regime, which did away with deferral and now requires companies to basically, absent a small return on their investments offshore, to bring back all their earnings and get taxed at either between 10.5% and 13 and 8%. That's sort of the minimum tax in the United States. So that minimum inclusion rule builds on the U.S. rules. It's meant to supplement CFC rules. It's not meant to do away with the CFC rules. And it brings along with it foreign tax credits, and it brings along with it mechanisms to avoid double taxation. And that's the income inclusion rule. The other approach that the Pillar 2 lays out is the base erosion approach. And again, these two rules are interrelated. We were having a discussion earlier with respect to whether can one apply without the other applying. And I think the way I look at these things, if you look at the income inclusion rule, think of yourself as a parent jurisdiction. Whether you have a foreign subsidiary or you have a branch under an exemption system. So if you have a subsidiary, this will require you to pick up the income at a minimum rate, whatever that rate might be for your jurisdiction. If you have a branch, instead of having the exemption system, it will switch into a credit system. So you have to pick up the income and then offset that income with any foreign tax credits you pay where the branch is being located. The base erosion is looked at more at the source country. So you're looking now at the source country and protecting its sovereign in terms of taxation. So that's why I think these two concepts should work interrelated. And what that second rule, the base erosion rule, is looking at is undertax payments. In other words, payments that are going to a related party that are not subject to tax in the source country, but also are not subject to a minimum taxation in the jurisdiction receiving that payment. And what that rule proposes to do, it's either deny the deduction at the source country level or subject that payment to a withholding tax, for example, a minimum taxation. And the other provision it introduces is a subject to tax rule, which relates to treaties. In other words, with treaties, if you have a payment that is subject to a lower level of withholding, let's say, for example, but it's not subject to a minimum tax in the jurisdiction of the recipient, then the treaty would basically, there would be an override for that withholding and subject to a higher rate of withholding because it's not subject to a minimum taxation. So that the base erosion, again, is trying to protect the source country in terms of its sovereign way of taxation, and then the inclusion rule is looking at the parent level. I think we have a case study here, Ricardo, right, to go through and maybe explore these rules in more detail.
Okay, we go then into this second case study, which is a simplified version of many cases you can find in your current practice. A parent company in any of the countries represented in the panel list. The United States, South Africa, India, Spain, Germany, and Korea, with fully fledged subsidiaries, either manufacturing or distribution companies. We aren't speaking about that. we are moving into the left side and the central side of the slide, with the IP companies resident in either in Ireland or Switzerland, although Switzerland is quickly changing its own regimes, and the finance companies located in Malta, Hong Kong, or Singapore. This amounts to a good question where the flags are from. I didn't know before this that Hong Kong had such a beautiful flag. So this is a traditional structure with license fees being paid to IP companies in low tax jurisdictions, and interest payments being paid by the parent company and by other companies in the group to the finance companies located also in low tax jurisdictions. So how will this minimum taxation proposal affect this structure? And I think that we could start. We have already listened to the already implemented rules in the United States, but maybe Suhail, you can explain to us which is the approach in India to the minimum taxation proposal.
So happily, at this stage, India has not defined or prescribed any rules on minimum taxation. We have something that's more akin in national law, but nothing in terms of international law, because not too many investments from India into low tax jurisdictions. They just held. So
It's pretty easy.
Yes, probably from a German perspective, I think it's not only a rumor, but it's true that the minimum taxation was an idea of our finance minister. And he, after he got this idea, he coordinated that with his French colleague. And I think it's now supported in particular by France and Germany to convince the inclusive framework on BEPS to support this idea. The key aspect from my point of view is that the idea behind that is to apply at the end of the day CFC rules, which from a German perspective and a European perspective refers to passive income, like generated by IP company and FinCo company, also to active income. So in our case study, that would mean from a German point of view, if minimum taxation is applied, that also the fully fledged production and distribution companies based in low tax jurisdictions like the US, like the UK, like Ireland. I don't know if Spain applies a tax rate below 25%. So the idea or the rule in Germany is that a low tax taxation begins under 25%. So you see in our case study here, that would mean that also the profits generated in the UK, in the US, for example, are subject to German minimum taxation, even if we are talking about active income. And from my point of view, it's like a expansion of CFC rules also to active income to ensure at the end of the day that group profits are taxed with the tax rate of the parent company. From a systematical point of view, I have really doubt if that can be correct, but that's the idea behind this minimum taxation.
Korea actually, as is the case of India, we have not seriously considered adopting any specific tax rule, tax rule about the idea of minimum taxation. But thing is, we already have sufficient tax law covering minimum taxation. For example, we have introduced specific anti-avoidance rules, substance over form rule into Korean transfer pricing regulation. And we have applied central management and control concepts, place of effective management concept. If there is any entities in tax haven or low tax jurisdiction and with no real business activities are not controlled by the resident in that jurisdiction, those those companies can be considered as Korean company, Korean tax purposes. And also, we have maintained very strict CFC rule. We both apply entity basis CFC rule and income basis tax CFC rule. So, of course, we will follow the OECD recommendation after they completed their review on Pillar 2, minimum taxation, and we'll definitely find a way to accommodate it. But my personal view, we already have sufficient strict rule to make sure that there is minimum taxation, to make sure the gap in international transaction, in the cross-border transaction is filled in, and to avoid any double taxation outside Korea.
I think again from Africa there's some mixed messages. You know, South Africa itself got highly sophisticated CFC rules and place effective management rules and all of that, because again it's kind of a country where a lot of multinationals headquarters are allocated. But then again, if you look at the more general position taken by ATAF, it's obviously looking again at mostly source countries, and so ATAF has a clear problem with the income inclusion rule, because a lot of African countries relying on tax incentives, you know, to attract foreign investment. I think that was mentioned earlier also by Colombia in the seminar. So those countries really rely on the tax incentives because they have competitive disadvantages in a number of areas. So they rely on that. So they're obviously opposing that. So from an African and ATAF perspective, again, the focus is more really on the base erosion payments. I mean, that's really their main concern is that, and the focus is clearly on some form of subject to tax rule to be included in the treaties. The advantage obviously is that's not only to related party in respect of related party transactions, it's also payments to unrelated parties. And then on top of that, also that's very much in line, you know, with the African reality of the withholding tax regimes that exist in most of those countries.
Xavier and Kim, I didn't hear any mention to base erosion. I thought you said more from a CFC or Germany and Korea being parent companies, but do you have anything on the base erosion payments that right now currently in place in Germany and in Korea?
In Germany, we know these rules, in particular with regard to license fees paid to low tax jurisdictions. And it's a good point, Ernie, mentioned by you. Here in our case study, I think it's also obvious if both mechanisms are applied in parallel, that can also lead to an international double taxation. So let's make an example that Germany applies both minimum taxation, which would mean that they tax the profits generated in Switzerland or in Ireland. And if they then apply, in addition to that, a license fee barrier rule, like it was implemented in German tax law, in addition to that, that would mean that the profits generated in Ireland or Switzerland would be taxed twice in Germany. And of course, from a systematical point of view, then that cannot be. Therefore, if both mechanisms are applied, then we need some rules which mechanism is applied firstly and which secondly, to avoid international double taxation.
Thank you, Ernie. It's a good question. And there is no specific rule like US BEAT on taxation on base erosion payment in Korea. But we have very strict transfer pricing rule. For example, if there is any license fee payment to the country, low tax jurisdiction with no economic and business activities and the substance, the license fee arrangement very likely denied for transfer pricing purposes. Deduction is denied. Effectively, although we don't have any specific the base erosion anti-avoidance rule like BEAT, and based on the operation of the transfer pricing rule, effectively we are applying very strict rule on the base erosion payment to certain overseas jurisdictions.
I think in an African context, you also need to consider that in a lot of jurisdictions, you still have some form of exchange controls or other regulatory restrictions, which effectively then limit the payments that you can make.
So this is interesting because we were speaking about the minimum taxation, and minimum taxation appears to be an additional measure to many other measures which are still in place. Now, the question is if, for any reason, Pillar 2 becomes a reality and similar instruments as those approved in the United States become commonplace and have to be adopted by all of the countries, we will still need tax avoidance rules in the tax world because, in a way, the international tax system has already a large section which is composed mainly by tax avoidance rules. It wasn't the case 5 years ago. It is becoming the case. So are we going to need new general tax avoidance rules with all these caveats and measures introduced probably in our legislations?
You know, what's interesting is if you take the U.S. as an example, Ricardo, in implementing the GILTI regime, they left all of their Subpart F regime, which is our anti-avoidance rules, in place as a backstop to the minimum taxation. So they felt that it was warranted because you can still enter into transactions that perhaps would fall within the Subpart F rules to get that minimum taxation, which is lower than if you're subject to the anti-avoidance rules. So a Subpart F, if you have a Subpart F income inclusion in the United States, that gets taxed at 21%, not at 10.5%. So in implementing the rules, the U.S. government felt that leaving the anti-avoidance rules would provide a backstop to the minimum taxation. And so they felt strongly that it should be in conjunction and keeping those rules.
Which is your view in other countries about this?
So from an Indian perspective, I'm sort of struggling to see how we could give more power to our tax authority. The general anti-avoidance rules are so vast and so broad that actually we will need to curtail some of that to bring certainty to the process. So just like Korea, while we don't have CFC, we have anti-avoidance rules, we have thin capitalization rules, and they give a lot of discretion to the tax authority, and we're looking for the government to bring some certainty to avoid the subjectivity and the litigations that come out of it.
So in Germany, we have a similar situation than you in India, Suhail. So obviously, also in our current tax law, the government is doing everything to avoid wide income, to avoid income taxed with a low tax rate. And therefore, my feeling is that they are also open for both approaches to implement them and to support them for German tax purposes.
I think it's the same in South Africa as well. The more tools the tax authorities have, the happier they are normally.
So then I think that with this we have covered all our presentation. I will again ask Javert to make some final remarks about the conclusions.
Yes, thank you, Ricardo. So what are the conclusions? I think our panel discussion showed that we have different interests of different countries. The industrialized countries think totally different on that development at the inclusive framework on BEPS than developing or newly emerging countries. And yes, I think the discussion showed that it will get very, very difficult. It will be a challenge to find a solution which is accepted by all countries worldwide. I have some concerns that the complexity will increase significantly, and consequently the uncertainty of multinationals will increase in the area of corporate income taxation as well. So let's see how things will develop. In the panel discussion this morning, the OECD representative mentioned that they would like to present a new report in 1 month. So that was my understanding. That was new for me. I thought that it will be a topic of next year, but that shows that they work on that, and therefore something will happen. I think we live in a very exciting time in the area of international taxation. So that was my conclusion. And yes, we would like to thank you for your attendance. Thank you very much. I would also like to thank my colleagues for their excellent contributions. Ernie from Taxand US, Suhail from Taxand India, Kim from South Korea, Jens from ENS Africa, which is Taxand South Africa, and Ricardo from Spain. We would now like to invite you to a reception. To be honest, I do not exactly know where it is. Ricardo, hopefully you.
Let me help you on that. Again, let me say one thing which is important. I mean, this is the first time in my life that a panel has been so disciplined that we have saved 5 minutes of the time available for the presentation. So there maybe the beer is prepared at 5:30. So we still have 5 minutes if anyone wants to make any questions to the panelists. The floor can ask whatever you want to ask or comment or add from other perspectives, maybe with more optimism, maybe with less. Anyone wants to say something? Well, thirst is a clear driver for us. So we are going to go to the 3rd floor to a place which is Skylon or something like that. But I understand that Kath and Emma are going to lead us to the 3rd floor. So again, thank you very much for your presence. We hope not to have clarified, but to have increased your doubts, which is the purpose of all the tax practitioners. See you next year. Bye-bye.